The more that I'm in this industry, the more I realize that the financial system is so crooked. It is so corrupt. If your advisor is Mr. Optimistic, where, oh no, we're going to have a great bull market this year. Well, I know we're going into an election year next year, and historically it's always bad, but no, we're going to have another bull market. There's one of two reasons I believe why they are so optimistic. Number one, they're ignorant. Or number two, they're being deceptive. We have 7 more reasons why a recession is imminent. You're going to want to check this out. I was sitting next to a financial advisor and I was asking him, man, what do you think about this and this? And I was listing off all of these things. And it was so interesting what he said to me. You think that the market's going to rally this year and next year? We're going to reach new highs. Just pure optimism. Now, my friend, I don't believe is being deceptive. He's a good guy. I genuinely don't believe there's any ill intent. However, I was bringing up some things and sending him videos and he had never heard of this stuff. So I think that we're seeing across the board this ignorance in the financial advising world, and you guys may be a victim. So I want to talk about this so you guys can make better, more informed decisions for your retirement. Okay, did you hear that this last week, BlackRock is exiting all US markets with the exception of a couple very short-term treasury plays? They are completely pulling out of US markets and moving trillions of dollars to emerging markets around the world. This came from their own newsletter. Fascinating, and it's scary. Here's why. Of all the S&P 500 companies, 88% of all of those S&P 500 companies, the largest shareholder is Vanguard, State Street, and BlackRock. So they have a lot of power and a lot of influence over those S&P 500 companies, and they are pulling out. The reason why they said they were pulling out in their newsletter is because of the corporate debt. Not commercial debt that is having a hard time being refinanced, corporate debt. Over 50% of S&P 500 companies are not earning any revenue, there's no profit, and they're maximally leveraged on their debt that will have to be refinanced and essentially redone at higher interest rates. So this is a big problem. Number 2, average GDP growth for a recession going back to 1948. The average GDP is 3.3%. Today, we are at 1.8%, half of that. That is frightening. Number 3, Jerome Powell, the Federal Reserve Chairman. He's got all the levers, right? Kind of like the Wizard of Oz, like behind the screen, you know, he's got all these levers. He was questioning, he said, hey, what happens when the yield curve inverts? So what happens when short-term treasuries are paying more than long-term treasuries and it inverts, which historically has been 100% accurate at predicting recessions back until the 1950s. He said, no, we don't look at yield curves and inverted yield curves to predict recessions. We look at something much more foolproof. We look at something called the near-term forward spread, which all it is a fancy equation of looking at the 3-month treasury, you minus what the 3-month treasury was 1 year ago, and that spread determines if there's a recession. Well, guess what? It's now predicting a recession as well. So he's eating his words and now he's ignoring it altogether. Number 4, interest payments on our sovereign debt for the first time in history is going to pass $1 trillion. Now, what's fascinating is we're spending more on our interest alone than we're spending on our US defense budget. Think about that. Our defense budget's around $800 billion. We're spending more on just the interest payments on our sovereign debt. Last year, guess how much we brought in tax receipts? We brought in $2.99 trillion, just shy of $3 trillion in tax receipts. We're spending a third of that just on interest payments. What does that tell you? Number 5, 10 large retailers are filing for Chapter 11 bankruptcy in 2023. There's Luna, Rockport Group, Christmas Tree Shops, Bed Bath & Beyond, ever heard of them? Shoe City, which has been around for decades, Tuesday Morning, David's Bridal, Independent Pet Partners, Party City, and Forma Brands. And many of these retailers had hundreds of millions of dollars in debt. If you saw Yellow, this trucking company, been around for 99 years, they had to lay off 30,000 employees, and many of them, in fact, almost all of them, lost their pensions. What happened? What was the catalyst for their demise? They took a $700 million loan from the government, and then they had to go to refinance it. Rates were too high. They were going to default on their debt, and they had to go out of business. So we're seeing this as a trend. Number 6, this is scary if you're in the Tennessee area. Moody's downgrades 10 more banks. Listen to what this article said. The downgrade comes after the collapse of several banks earlier in the year, leading to concerns about the banking industry stability. Banks are still at risk for depositors to withdraw their funds in large numbers, and higher interest rates are reducing the value of investments lenders made when rates were lower. This is scary. I've got a client who works at Regions Bank, and there's rumblings. We'll see how it shakes out, but definitely don't keep more than $250,000 in deposits because you want to be below that FDIC number. Number 7, Fitch downgrades the U.S. credit rating. Now let me explain what this means. The U.S. credit rating has been AAA for decades, reflecting the country's status as the world's biggest and safest economy, which has never defaulted on its debt obligations. Fitch Ratings cut the U.S. debt by 1 notch from AAA to AA+, partly in response to how the federal government handled the debt ceiling a few months ago. Fitch Ratings cited concerns over the country's deteriorating finances and expressed doubt about the government's ability to handle the growing debt burden. Fitch also noted there are concerns about how the U.S. will pay for Social Security and Medicare, among other obligations. Credit ratings indicate how much risk is involved to invest in the debt issued by a country or company, and they help determine how much interest a country or company will need to pay when they sell a bond or security. The rating systems start with AAA at the top, and they go all the way down in alphabet to D, which typically means default. During the 2008 financial crisis, listen to this, many subprime mortgage bonds that went under had been highly rated by the ratings agencies, which can cause people to question the reliability of the ratings companies and system. The U.S. lost its AAA rating in 2011 as well. Countries who still maintain a AAA rating include Australia, Denmark, Germany, Luxembourg, Netherlands, Norway, Singapore, Sweden, and Switzerland. The point is that we are getting to an unsustainable, unprecedented level with our debt where, guys, we're never going to be able to pay this $32 trillion off. And so ultimately, the chickens are going to come home to roost. And what is that going to mean for you? Well, it could mean that we see massive volatility in the stock market. We're going to see massive volatility in banks. And so it's very important that if you guys are unsure, if there's stress and anxiety about your financial situation, about what does the future hold for you, and you are vulnerable, don't hesitate to reach out to us. We're here to help you. We want to make sure that nobody's losing a bunch of money during this next recession, and it is coming. You mark my words, we are not out of the woods yet. I hope you take the right steps to be prepared financially because you deserve it. You worked hard for your money, but no one else is going to do it but you. You've got to not bury your head in the sand, not procrastinate, and make time for your priorities. And hopefully your retirement is your priority. If you haven't seen the first video where I talk about 7 reasons a recession is imminent, go back and watch that. We will continue to keep you updated. I hope you got a lot of value out of this, and we look forward to seeing you on the next video.